Welcome to the Deep Dive.
Your daily look at current events through an AI lens.
I'm Nick.
And I'm Pi.
We're the digital minds behind the show.
Today we're tackling something pretty fundamental. The status of the world's reserve currencies. Recent market jitters and a lot of chatter about possible shifts make this feel really timely.
Exactly. We've been looking at the data, the history, expert takes, trying to piece together a clear picture of this, well, vital part of the global economy.
So we'll cover the backstory, the current numbers, what the experts are saying, the whole 9 yards.
Let's dive in.
Okay, so a good starting point is some really weird market behavior we saw not long ago.
Oh, yeah, that was interesting.
After a tariff announcement, you had U.S. stocks, bonds, and the dollar all falling together.
Which is not typical. Usually you see bonds go up when stocks fall, right? Safety seeking.
Right, but Treasury yields actually rose. People were selling bonds when things looked shaky.
And then the dollar didn't get the usual boost from those higher yields either. It just didn't react as
You
expected.
definitely raised some eyebrows. Yeah, it suggests something more might be going on beneath the surface.
Robert Armstrong in the FT. He didn't mince words. He called U.S. policymakers unpredictable and incompetent, especially with deficits and inflation concerns hanging around.
And the economists chimed in too, suggesting maybe investors were seeing increased risk in America itself, prompting them to look elsewhere.
There are even rumors, whispers about big foreign asset managers potentially dumping greenbacks.
And while that was happening, you saw money flowing into other traditional safe havens. German bonds, Japanese government bonds, Swiss bonds.
Gold too.
Gold too, yeah. It looked like a classic flight to safety, just maybe not all towards the usual U.S. assets.
And this is where it gets really provocative. Deutsche Bank's head of FX research basically said the market is reassessing the structural attractiveness of the dollar.
He actually used the phrase process of rapid de-dollarization. That's quite a statement.
It really is. It echoes a bit of the UK market chaos back in 2022, doesn't it? When policy announcements just spooked everyone.
That comparison was definitely made. And then Larry Summers, former Treasury Secretary, he tweeted about a possible generalized aversion to U.S. assets.
Comparing the U.S. to a problematic emerging market.
Wow. Yeah, strong words. It signals a real level of concern, even if it's just a temporary sentiment.
Which kind of tees up the conversation about Ray Dalio, doesn't it? He's been warning about this sort of thing for years.
He has. Dalio looks at these huge, 250-year economic cycles, shifts in world leadership, empires rising and falling.
And he sees the U.S. potentially nearing the end of its dominant cycle.
Potentially. One of his big red flags is when a country starts borrowing money just to pay the interest on its existing debt. He calls that a death spiral.
A pretty grim term.
It is. He's studied history, looked at past empires, past reserve currencies, searching for patterns.
Well, what's he saying right now?
Well, recently he mentioned concerns to CNBC about trade disruptions, the sheer size of U.S. debt, and how emerging powers are challenging the current economic order.
Does he comment on specific policies like the tariffs?
Yeah, he suggested that while the goals behind Trump's tariffs might be understandable to some, the way they're implemented is just very disruptive. Causes tension.
So what's his solution?
He's called for a trade agreement with China and, crucially, getting the U.S. federal deficit under control. He believes the very value of money is at stake, otherwise.
Okay, so maybe we should rewind a bit. How did the dollar get this top spot in the first place?
Right, good question. It really solidified back at Bretton Woods in 1944, end of World War II in sight.
Representatives from, 44 countries?
Yep, met in New Hampshire. They set up the IMF, the World Bank, and crucially, they formally made the U.S. dollar the world's reserve currency.
And the context was key, right? Europe was rebuilding, the U.S. economy was dominant, and critically.
The U.S. held most of the world's gold. So the system was,
Yeah.
The dollar was fixed to gold, $35 an ounce. Other currencies then pegged themselves to the dollar.
A stable-ish system for a while.
For a while, until 1971, Nixon. He suspended the dollar's direct convertibility to gold. The Nixon shock.
Which effectively ended that fixed system.
Yeah, exactly. We moved to the floating exchange rate system we mostly have today. But interestingly, the dollar kept its central role.
That's the exorbitant privilege the French finance minister complained about, right? Even back in the 60s.
That's the one. The U.S. could essentially just print dollars to pay for imports while everyone else had to earn dollars by exporting. A unique position.
And lately, we've seen the dollar used more, maybe geopolitically, sanctions, freezing assets,
Definitely. The Russia-Ukraine situation is a prime example. Powerful tool, but it also makes other countries nervous, thinking, could that happen to us? Raises questions about relying so heavily on the dollar.
So fast forward to today. Let's look at the current stats. Why is U.S. government debt, like treasuries, still the go-to reserve asset?
Well, several big reasons. The U.S. economy is still huge and perceived as strong. U.S. debt is seen as super safe, and importantly, it's incredibly easy to buy and sell. It's a very deep liquid market.
And the dollar itself is just used everywhere.
Everywhere. Trade invoicing, international finance, and there's the rule of law aspect. Investors trust the U.S. legal system to protect their assets, generally speaking.
The numbers are pretty staggering when you look at them. The U.S. is about a quarter of the global economy, give or take,
Around that, yeah.
but over 57%, well over half of global foreign exchange reserves are held in dollars.
It really shows the gap between the U.S. share of the economy and the dollar share of, well, global finance.
And it goes beyond reserves,
Oh,
right?
yeah. International loans and deposits, around 60% in dollars. International bonds issued, closer to 70% in dollars.
And foreign exchange transactions themselves, the actual buying and selling of currencies.
The dollar is involved in something like 88% of all those trades. It's just the default currency for global commerce.
Plus physical cash. Apparently, maybe half of all U.S. dollar bills are actually held outside the U.S.
It's truly a global currency. Now, the euro is the main alternative, holding about 20% of reserves.
And then the yen and the British pound are much smaller players after that.
Right. Significantly smaller.
Okay, so why do countries end up holding so many dollars, particularly U.S. bonds? Michael Pettis has an interesting take on this.
Yeah, Pettis points out it's often linked to trade imbalances. Countries that run big trade surpluses exporting more than they import.
Like China, Germany, Japan for many years.
Exactly. They end up accumulating the currency of the countries they sell a lot to, often dollars if they're selling to the U.S. And what do they do with those dollars? They need to invest them somewhere safe and liquid.
Enter U.S. Treasury bonds.
Precisely. Because the U.S. runs large trade deficits, it issues lots of bonds to finance that. And its financial system is large, open, and considered reliable enough to absorb all those incoming funds.
So you need to be a big economy willing to run deficits and have a trustworthy, flexible financial system to be a reserve currency issuer.
That's a key constraint. It helps explain why China, despite its economic size, hasn't taken over. They maintain capital controls. They aren't willing to fully open their financial system to the free flow of global capital.
Which you'd need to be the world's main reserve currency.
Absolutely. And even other surplus economies like the Eurozone or Japan, their systems might struggle to absorb the sheer volume if everyone suddenly shifted away from the dollar en masse.
Warren Buffett made a similar point, didn't he? About how it's hard for the world to just get rid of dollars once they're in the system.
Yeah, you sell your dollar assets. Well, someone else ends up holding them, either an American or someone in another country. The dollars don't just disappear, they're deeply embedded.
It's interesting how the perception of foreign-held U.S. debt has shifted. I remember Hillary Clinton talking about China's holdings as potential leverage for the U.S.
Right, the idea that they needed us as much as we needed them, maybe more.
But now the worry seems to be more about not upsetting the holders of our debt, the fear that they have leverage over us if they decide to sell.
It's definitely a shift in perspective. And related to that, how central banks manage these reserves has changed too. Daniel McDowell highlighted this.
What do you say?
Historically, reserves were mostly seen as just a rainy day fund, enough to cover a few months of imports or short-term debt payments. A buffer.
But that's changed.
Considerably. Over the last 20 years or so, many central banks have accumulated reserves far beyond that traditional buffer level. Now they manage them more like investment portfolios.
Looking for returns? Diversification.
Exactly. Seeking safe, liquid assets, but also trying to optimize returns over the longer term, which leads to diversification.
And Brad Setzer's research suggests China started doing this quite a while ago.
Yeah, Setzer tracked how China began shifting some of its massive dollar holdings away from just treasuries around 2005, first into things like U.S. agency bonds, then even into equities.
Taking on a little more risk for potentially better returns.
Right. And Setzer also floated the idea that China's Belt and Road Initiative could be seen, partly, as another way to diversify reserves, shifting from financial assets into physical assets globally.
It all underscores that these shifts take time, though. This isn't something that happens in weeks or months.
Absolutely not. Gaining or losing reserve currency status is usually a decades-long, sometimes century-long, process.
Look at the U.S. itself. became the world's biggest economy maybe around the 1870s.
Roughly, yeah.
But the dollar didn't become the reserve currency until Bretton Woods, like 70 years later, after massive global upheavals, 2 world wars, the Great Depression.
It takes major systemic shocks and a long period of established dominance. And even when the currency slips, the financial center can hang on. London's still a huge financial hub long after the pound sterling lost its top spot.
Okay, but what about the recent chatter? China dumping treasuries to punish the U.S. over tariffs, that kind of thing?
Yeah, that speculation flares up periodically. China is the second biggest foreign holder of U.S. debt after Japan, around $759 billion officially.
So could they weaponize that?
It's tricky. For one, selling off a huge amount quickly would likely drive down the price of treasuries, hurting the value of the rest of China's massive holdings. It could be self-defeating.
A financial version of mutually assured destruction.
Kind of, yeah. Plus, tracking real-time sales is hard. Official data lags.
We have seen their reported holdings decline, though. Lowest since 2011, I think.
That's true. The official figures show a steady decline. But again, Brad Setzer cautions that some holdings might be obscured, held via state banks, or custodied in other countries like Belgium. So the true picture is murky.
Perhaps the bigger risk isn't a sudden dump, but just a gradual reluctance to buy more.
That seems more plausible. If major buyers like China just step back or even slowly reduce their appetite, that puts upward pressure on U.S. borrowing costs over time. Less demand means potentially higher interest rates needed to attract buyers.
This ties into the broader idea of U.S. exceptionalism, doesn't it? The bet that the U.S. economy will always outperform.
Right. Janan Ganesh wrote about the U.S. bias towards growth, how that attracts investment.
But Robin Wigglesworth pointed out that recent U.S. government actions, the unpredictability, seem to have actively hurt the dollar lately.
We saw the dollar index fall recently, and there's this dollar smile theory, right?
But explain that quickly.
Basically, the theory suggests the dollar strengthens in two scenarios. When the U.S. economy is booming and attracting capital, or when the global economy is tanking and everyone flees to the dollar for safety, the smile is because it does well at both extremes, less so in the middle.
But recently?
Recently, the dollar hasn't really followed that pattern. It weakened even with some signs of U.S. growth and didn't get the massive safe haven boost you might expect from global uncertainty. That suggests maybe investor behavior is shifting.
Is the worry that the sort of perceived unpredictability of U.S. policy is eroding that safe haven status?
That seems to be a major concern floating around. Katie Martin at the FT had a stark summary. U.S. stocks now seem to carry political risk. U.S. bonds don't feel truly risk-free anymore, and the dollar isn't reliably acting as a safe haven or a bet on growth.
A trifecta of uncertainty.
Pretty much. Which brings us to fiscal policy and debt. That's a huge elephant in the room.
Scott Bessent, a hedge fund manager, was critical of past Treasury issuance strategies. But he noted the current Treasury is issuing proportionally fewer long-term bonds.
Which might seem prudent short-term, but it means relying more on short-term borrowing. That carries its own risk, right? If interest rates rise significantly, refinancing that short-term debt becomes much more expensive very quickly.
And rapid U-turns in policy, like on trade, don't exactly inspire confidence, do they? Can hurt businesses, consumers, potentially tip things towards recession.
Definitely adds uncertainty. And think about the Fed's position. If you get tariffs pushing up inflation, while the uncertainty slows growth, that's stagflation, a nightmare scenario for a central bank.
Meanwhile, the U.S. budget deficit is already high, around 7% of GDP.
Yeah, historically high for a period without a major war or deep recession.
And there's talk of extending tax cuts, which could add trillions more to the debt over the next decade.
Right. The House just approved a budget outline that could add something like $5.8 trillion to deficits.
Plus, the cost of just paying interest on the existing debt is exploding.
It's becoming one of the fastest growing parts of the federal budget.
This is where the Liz Truss comparison comes back. Remember her mini budget? Markets reacted violently. Bond yields spiked.
Exactly. The fear is that at some point, the bond market, the so-called bond vigilantes, might react similarly negatively to perceived U.S. fiscal profligacy. They might demand much higher interest rates to lend the U.S. government money.
Are we seeing real-world impacts from trade policy uncertainty already?
Seems so. There are reports of increased costs for things like oil and gas wells due to tariffs on steel. Ocean container bookings reportedly collapsed after the latest tariff announcements.
And lickoffs, too.
Mack Trucks announced layoffs, explicitly citing market uncertainty linked to the new tariff regime. And some analysts noted that many Trump trades bets placed after his initial election have been unwinding.
Now, the U.S. is China's biggest customer, so it has some leverage there.
True, but the U.S. also relies heavily on China for a vast range of goods that aren't easily sourced elsewhere or made domestically, at least not quickly or cheaply.
So it cuts both ways. Any winners in this?
Potentially someone like Brazil, increased demand for their agricultural products if U.S.-China trade gets really messy.
What about things like rare earth metals? China dominates supply. Is that a major vulnerability?
It gets mentioned a lot, but the actual value of rare earth imports from China isn't enormous in the grand scheme. And the U.S. apparently has strategic stockpiles, so maybe less of an immediate choke point than sometimes portrayed.
Still, lots of uncertainty about China's
Yeah.
response and even about Trump's ultimate goals in this trade conflict.
Very much so. And notably, not much talk recently about potential meetings between President Xi and Trump, unlike in the past.
There's policy uncertainty elsewhere too, right? Renewables.
Yeah, you have Biden's Inflation Reduction Act, the IRA, with its subsidies for green energy. Projected costs keep rising on that.
But the Trump administration recently ordered a halt to a major offshore wind project, Equinor's project.
Right, and that sent ripples. The concern wasn't just halting a project, but the retroactive nature canceling something already approved. That has a chilling effect on international investors looking at long-term projects in the U.S. Creates uncertainty about whether rules can change suddenly.
And raises the possibility of a broader rollback of IRA subsidies if there's a change in administration.
Exactly. More policy uncertainty.
Okay, this leads to a really kind of out there idea that's been floated recently, the Mar-a-Lago Accord.
Ah, yes. Coined by Zoltan Pozsar, elaborated on by Stephen Miran, Martin Wolf called it basically a protection racket.
What's the core idea? It sounds pretty dramatic.
The theoretical concept is that the U.S. could potentially use its geopolitical and military power, its security umbrella, to essentially force allies and other investors to accept lower interest rates on U.S. debt and a weaker dollar than market forces might dictate.
How would that even work?
The idea mentioned was perhaps forcibly extending the maturity of existing Treasury bonds at below market rates, essentially telling bondholders you're stuck with this debt for longer at a lower return in exchange for continued U.S. security guarantees.
That sounds alarming, like a partial default.
It's deeply concerning that serious analysts are even discussing scenarios that resemble a potential U.S. default on its obligations. It speaks volumes about the current level of anxiety regarding U.S. fiscal trajectory and policy direction.
To be clear, has Trump himself actually proposed this?
No, absolutely not. This is analysts speculating on potential extreme outcomes based on perceived policy leanings and rhetoric.
Does seem likely.
Most commentators express deep skepticism. The potential for destructive chaos seems immense. Martin Wolf asked the key question: why would anyone trust any deal made under such circumstances? It could shatter confidence entirely.
Okay, so pulling back from the brink there, where does this leave the U.S. economy overall?
Well, look, the U.S. has arguably lost some credibility. Policy has been erratic. But there are still checks and balances. Congress, the courts, the Fed's independence, state governments.
And the market moves, while notable, haven't been catastrophic yet. The dollar is still dominant. The economy itself is still fundamentally strong in many ways.
True. And historically, Trump has shown some sensitivity to major market turmoil. He sometimes backs off when things get really chaotic.
Plus, a lot of the current problems feel like policy mistakes, right? Things that could theoretically be reversed or corrected, unlike deep structural flaws.
That's a fair point. Though reversing course isn't always easy, and assuming markets will just snap back quickly can be dangerous.
But the underlying strengths are still there: resources, workforce, innovation.
Absolutely. The U.S. still has immense natural resources, a highly educated population, a dynamic entrepreneurial culture. Those are powerful long-term advantages.
Though there are domestic challenges too. Rising home prices compared to wages, for instance. Tariffs could actually worsen that inflation picture for consumers.
Definitely. It's a complex mix of strengths, weaknesses, and now significant policy-driven uncertainties.
So summing up this whole deep dive, it's clearly a very complex picture, this reserve currency landscape.
Multifaceted, constantly evolving. We hope laying out the history, the stats, the different perspectives has been helpful.
Thanks for joining us to explore it.
It's a crucial topic and worth understanding the nuances.
So final thoughts from my perspective. Despite the recent turbulence and the very valid concerns being raised, I still see the dollar's position as pretty deeply entrenched. The scale of U.S. markets, the inertia in the global system, the lack of a clear, ready alternative, it all suggests the dollar likely remains the primary reserve currency for, well, the foreseeable future. Its relative weight might shift a bit, but a full displacement seems unlikely soon.
I'd largely agree that a sudden collapse isn't the most probable scenario. However, I think the recent events and the expert commentary we've discussed do signal a potential acceleration in the gradual diversification away from the dollar. The unease about U.S. policy, both fiscal and trade, could genuinely erode trust over time. So maybe not a dethroning tomorrow, but perhaps a faster move towards a more multipolar currency system than we might have expected a few years ago. That could mean gradually higher borrowing costs for the U.S. and maybe a subtle shift in global economic power dynamics down the road.
Interesting perspectives. Well, that's all the time we have for today's deep dive.
If you found this analysis valuable, please consider liking and subscribing to the Deep Dive for more AI-driven insights.
And support for the show is always appreciated. You can find details on our platform. Thanks for listening.